All right, highlight of the day, fading a market, but waiting for the right time. We had two moments. The first one had a decent pop. The second one ended up calling the bottom. I recorded the first one, and that's you don't want to be long when there's too many other longs. You want shorts to have to come in on a move lower. Other people are trying to pick the bottom all the time, looking for a bounce, looking for a bounce. Generally, people do that because they miss the downside, so their brain tries to get them to do the opposite. But there's always support levels on the way down that people are trying to buy. So any break is going to have people that get stuck if there's enough sell pressure to keep pushing through, which becomes a self-fulfilling prophecy and makes a move extend lower and lower. But you don't want competition if you indeed are looking to fade and qualify a support level to buying it long. So when you look at, I want you to just pay attention to this side of our OPP, other people's positions. You could see the longs that are getting in on the way down, which is keeping the fuel to the downside. But a big seller comes in, that's this red box. And if I take this and move it a little fast forward, you could see it get red again right in here. All right. Now they're already still long, but they've been long on the way down. The fact that there's new shorts. You ever hear the saying "stuck in the hole"? It's a saying from the trading floor. Short in the hole or stuck in the hole. Short in the hole is you sell it, and the chart ends up forming a hole. Right, comes in, comes out, and you're short from down there. You want to see that dynamic play out in order to qualify a better location for a long. So you see it right in here. Come in for the pretty much for the first time. That kind of number of longs that come in for the first time in this particular move lower. All right. So it did mark the first bounce, but a couple other things happened. Some of these longs went away, which is what you want to see for upside. But so shorts came in, and another interesting thing happened if you pay attention to right here on the red. More shorts got in on this little bounce. So what we'd said is this is a time to get in, and this is confirming there should be a little bit more upside. Let me back it up and play it through, back it up, play it through. You see the reds pop out. If I continue to play, you see a big red come in, kind of a big red come in there. There he is, 29.50. And as it goes up, you continue to get more reds come in than greens, and the market's going from net long to less and less net long. And these are the shorts that are stuck, creating another big red bar popping out, creating the fuel for the upside. So any bounce that you're looking to play, and this is like a decent bounce. I think it went 5 or 6 ticks from these lows. Now it revisited the lows, but the key to this business is getting a head start. You know, good locations are defined by how soon does a trade go your way, where it could start paying you so you could start playing it from the profit side. You want to avoid taking immediate heat. You want to avoid taking trades where every time you put on a trade, you take heat. Those are bad locations. Even if you end up being right, if you have to take heat and wonder and self doubt whether or not you should get in, get out, it's hard to build size in a business or in a trade when you're taking heat all the time. There's a lot of emotional capital spent. So you want to pick good locations. That is everybody's step. There's that step is part of everybody's trading plan. Whether you're a short time frame scalper, whether you're a swing trader or an investor, whether you trade the NASDAQ, crude oil, individual stocks, options, yes, whatever you trade, everybody has to get in and out real time, and good locations are important. So good locations are always a common denominator, no matter what you trade or what style or time frame you trade. So anybody that comes to me and says interested, they want to find the exact time frame and style as they are, okay, I could see that, but make sure whomever you're going to invest in to try to learn trading, it has to always have underscored location, because location, you could be wrong, but with good locations, not lose money. You could make money and be wrong because your locations are good. On the flip side of that, how many times have you heard me say you could be right in price direction and lose money? It's because your timing and locations were poor. So get out of your own way and understand that we call it step 3 is your fire. We call it step 3 or fire in ready, aim, fire. Fire is a common denominator step in everybody's trading plan and strategy. And I know it to be the weakest link in anybody's trading strategy and plan. So you've got to have the tools to get yourself open into a long or short position at better locations, at better points in the trade or in the chart. And so you don't have the competition of all of this if you're trying to be short. You want to see other people stuck. Remember, we are predators. And in order to be a good predator, you got to identify the prey and you have to have a process in which to know when to pounce so they don't get away. They're going to get away. You're going to miss, but you don't want to be the prey. And too often when people get into this business, unbeknownst to them, they open up a trading account and they got a target on their back. They're the prey. They're the ones that are on our charts. So you want to be devoid of competition. When you're long, you don't want many others long with you. And when you're short, you don't want many other shorts with you. You want the other side so you can go in there and see them bleed in order to create the fuel to go up. Remember, after you buy it, you're a seller.